Right. Welcome, everybody. My name is Scott Campbell. I am going to share my screen with you. We're going to go through some presentation here, a PowerPoint presentation that's going to go over the information that we advertised for the webinar. And this is going to be covering all of the planning opportunities that we have. So please let me know if you can see my screen. Raise your hand. All right, fantastic. So what I wanted to do is give you some immediate steps that you can take now, some advice. Please don't take this as individualized advice. This is advice in general. If you want individualized advice, please send me an email or give us a call. If you're not familiar with me, my name is Scott Campbell. I'm a registered investment advisor. We've been on the corner of 15th and West Avenue for the last 20 plus years. We do holistic financial planning, and we specialize in retirement income planning. So today we're going to cover the CARE Act and retirement, what it means to you, what you can do and take advantage of some of these things, life insurance, lines of credit, and finally market risk. So let's just jump into this. You are able to take up to $100,000 out of your retirement accounts, your 401ks, your IRAs, your 403bs, without a 10% penalty. So this is going to affect people that are under the age of 59 and a half. You can pull money out. It's still a taxable event, but you're not going to have to pay that 10% penalty. So we're going to have access to this money faster, sooner, cheaper than before. You technically have to qualify. So these are the things that need to have happened for you to actually qualify. But I think the second bullet point there would make all of us eligible. Basically, we have some type of adverse financial consequences because we've been quarantined. That's going to pretty much say, okay, everybody has access. Let's go ahead and take some money out if we need to. Now, remember, it is still a taxable event, but you can pay it back over the next 3 years. And you can pay the taxes over the next 3 years if you want to. So the way that they're setting this up is they're saying, okay, if we want to pull some money out, you can. Yes, it is a taxable event. No, there's no 10% penalty if you're under the age of 59 and a half. And if you want to pay the taxes on that money over a 3-year period, you can do so. In addition to that, you have the ability to pay that money back. If you want to recontribute those funds within the same 3-year period, you can do so, and it will not count towards the maximum contribution limit in those upcoming years. So what does this mean? This means that you could take money out this year, there's no penalty, and it's really a tax-free loan, or it's an interest-free loan for you if you end up giving that money back to the qualified plan over the next 36 months, beginning in 2021. So this is a significant planning opportunity. Get cash without having to worry about those excess fees. Now, what if you're on the other end, you're a little bit older and you're having to worry about taking out required minimum distributions? So the Secure Act had changed that age limit to 72 at this point. But if you were already taking out required minimum distributions, or you were supposed to start this year, you do not have to worry about that. They've waived required minimum distributions. And I always like to bring this up. It is not required for you to pull money out, but you're still able to do so. In other words, it's up to you, but they're not requiring you to do so. This also will affect your inherited IRAs. So if you have an inherited IRA and you're supposed to pull out an RMD, you do not have to do that this year. Somebody had already asked, does this help us with non-qualified annuity products in 2020? Excuse me, that's going back to the age 59 and a half. No, you cannot pull money out from the non-qualified annuities and then eliminate the 10% penalty. This CARE Act did not make that change. Back to the RMDs. Again, there's no RMDs for this year, so you can basically move on. We talked about some planning opportunities, and I think the biggest opportunity is going to be Roth conversions for this year. That and tax harvesting, tax loss harvesting. We're going to talk about that next week. But Roth conversions are a significant opportunity. And I want to remind everybody that a Roth conversion is different than a contribution. A contribution means you're taking money and you're putting it into the Roth for the very first time. You have to have some type of wages. You have to have payroll to be able to do that. A conversion means we're taking money from your existing 401k or IRA, some type of tax-deferred retirement account, and we're converting it over to a tax-free environment. Very important, that conversion is a taxable event. That taxable event may not be taxable. Now, hear me out. It may not be taxable. Let me give you an example. I do a lot of classes at UT Informal Classes, St. Ed's Professional Education, ACC, and I was doing a class on taxes and retirement. And at the end, a gentleman came up to me and he said, that was very interesting. And with a very big grin said, I haven't paid taxes in the last 3 years. And I haven't even filed a return. And so, of course, I asked, legally? He said, yeah. I said, all right, well, give me some more information. What's going on? He said, well, we retired early. I have a large 401k. We haven't tapped into Social Security yet. There's no pension. So we just haven't filed the tax return. And I said, okay, tell me about your Roth IRA. And he said, oh, we weren't eligible to contribute to the Roth, and so we don't have one. And somebody said, if I do a conversion, it's going to cost me taxes. And I said, okay, don't shoot the messenger. Don't shoot the messenger. But under today's current tax law, you have a standard deduction. And in 2020, it's what, $24,800 per married couple. And you either use that standard deduction or you lose it. Meaning that person who doesn't have any taxable income could have taken $24,800 out of the traditional IRA, converted it to a Roth. That is a taxable event where they would have paid zero in taxes. Now, a lot of people are getting furloughed, they're getting laid off this year, and your taxable income might go way down. It might not get to zero, but it could go significantly lower than we thought, which is this opportunity for us to do Roth conversions. We take the money that's already been depressed by the stock market, we combine that with your lower tax bracket this year, and boom, it's a huge planning opportunity, moving that tax deferred money to tax-free. And when I say huge, I mean huge. We can do an analysis to show you, if you do Roth conversions, how much is that going to help you in the long run? In this example, it's over $1 million for this particular example that we set up. That blue area that you're seeing, that's doing Roth conversions over years. And if you've never had this analysis done, if you've never taken a look at, will a Roth conversion make sense for me or not, please email me, scott@austinfirstfinancial.com. We will do a Roth conversion analysis for you and help you understand, does this make sense? Okay. It is a very powerful technique. Let me move on to life insurance. Life insurance, the existing policies are going to cover the virus. All right. So if you have existing life insurance, it will cover the virus. The problem is that some carriers may stop issuing new policies if things get worse. And if that happens and you're in a position where you need a new policy, you better act quickly. In other words, reach out, get that life insurance, get it started, and add it, for your family. Who knows where we're going to go as far as this virus is concerned. I saw recent stats that the death rate has slowed down a little bit. That's fantastic. But the rate is also spreading to more areas. We all know the major cities like New York and New Orleans, they're being hit. I just saw a story today that Denton has a whole facility that got hit today here in Texas. So listen, if this is important to you, reach out, get the life insurance started quickly. This brings us to lines of credit. This is a lesson from 2008, 2009. If you have a home equity line of credit or you have a business line of credit and it's there, it's accessible for you, I want you to think about taking that credit and moving it into your checking or your savings account. In other words, access that credit and move it where you can have access to it. Because unfortunately, the banks have the ability to kind of revoke that credit. They can pull it from you. And that happened in 2008 and 2009, and it left a lot of people scratching their head in a very bad situation where they thought they could rely on this line of credit, and it was removed from them. It was revoked. So again, if things get uglier, we want to make sure that you have that cash on hand. Okay. And let's talk about the market risk. So as of Friday, the S&P 500 was down almost 23%. We had a significant jump today, which was fantastic. But we're going to see a lot of this volatility, a lot of this movement, both up and down, until this thing kind of plays out. And we know that the jobless claims are coming in at a historic rate. We know that major players in the market are not going to have earnings reports that are attractive as the quarterly reports come along. And so we're going to see some very large gains and some very large losses. What I want you to understand about this is that this is the fastest we've ever had a 30% sell-off. It's been very, very quick. So from the beginning of the sell-off to the 30% fall, it was 22 days. And if you do the math, if you fall 30%, you need like a 45% gain just to get back to even. So with all this up and down, all this volatility, there's a lot of news out there about what you should do in this market situation. And unfortunately, it's very generic, right? Because we're getting so much bad news, this generic advice is not okay. It is just not okay. In other words, you need individualized advice, not generic. Let me give you an example. The news to keep contributing to the 401k and buy and hold and don't worry about the money, because if you don't sell, you're not going to incur a loss. And in 5 years, we could be back to historic highs. That type of advice might play for this guy. It might play for the millennial. But what about the person that's relying on the 401k money for income? What about this person? That's not good advice for this person. They probably need something a little bit more individualized, less generic, and that could be you. And getting good advice is important, and understanding how much risk you're taking is very important. So here's another report that we do, and this helps you understand how much risk you're taking in your portfolio. And it's really simple. They kind of set you up on a scale of 1 to 100. 100, we're trading Bitcoin. 1, bank insured CDs. And it helps you realize the swing, the volatility, the amount of risk that you could take in the overall portfolio. And I want to let you know right now that if you have individual stocks, you're taking on individual company risk. And there's going to be some companies that are going to come out of this really strong. But there's going to be some big name companies that are going to have a really difficult time. Their balance sheets are carrying a lot of debt, and they're not going to get through the situation very well. I would say if you don't need to have those individual stocks in your plan for retirement, if you're close to retirement, I'd rather see more diversification through something called an exchange traded fund, an ETF. They give us the diversification of a mutual fund, but they trade like a stock. They're very tax efficient. They're very nimble. They're low cost. And an ETF cannot go to zero, but an individual stock can go to zero. So let's get some more diversification into the portfolio and make sure you understand how much risk you're taking or not taking with the overall portfolio. If you would like a complimentary risk exposure review, email me at scott@awesomefirstfinancial.com. We will set you up with one of these. It's very important for you to understand how much risk you're taking. How about some alternatives to equities? We like treasury-based ETFs, again, exchange-traded funds. So these are ultra short-term funds that invest in US Treasury notes with maturities of less than a year. So the price does not move very much. In other words, let's say the price of the ETF was 100. It's going to move just a little bit, 99, 101. It's not going to move a lot, but you're going to get yield. You're going to get yield put into the portfolio. So interest is going to be added to the portfolio. This also gives us some wiggle room and some ability to stay away from the volatility and let this thing kind of pan out. And then for our clients, if you're one of our clients, we plan to get back in at some point as things stabilize, and it'll be at a much lower spot than what we got out. So again, if you're one of our clients, we started to exit the equity markets back on February 24th, got completely out by the end of that week. We're now kind of in the short-term, ultra short-term treasury notes. How about another example? What if you want some fixed guaranteed interest? If you're not familiar with multi-year guaranteed rate annuity products, these are giving us pretty darn good returns. And let me show you how they work or how we like to use them. We like to ladder them. We ladder the maturity dates. So these products are usually 12 to 60 months, and they're going to give you a safe, fixed, guaranteed interest rate. There's no fees on these products. They're regulated. And what we like to do is kind of ladder the maturity dates. So for instance, let's say we had $120,000. We might take $40,000 and put it into a 1 year, $40,000 into a 3 year, and then the final $40,000 into a 5 year. And we're doing that because you're going to get better interest rates with the longer terms. And what's nice is that at the end of that first 12 months, that first $40,000 plus the interest is now liquid. And you have the ability to put that into your checking account, or if you don't need it, we can roll it to another 5-year product. And why do we say 5-year? Because that's the sweet spot. That's where you're going to have the largest yield, the largest return. So for example, right now on a 1-year product, you can get about 2.5%. On a 3-year product, about 2.8%. But on a 5-year product, you can get 4%. Now, 4% is fantastic today. Look at what the banks are paying. They're not paying anything near that. So if you can afford to set some money aside, there's no liquidity here. You got to wait the full 60 months. 4% guaranteed on a guaranteed growth product is very attractive. And then with the maturities, with the laddering, you're always going to have access to a third of that money between 12 and 24 months. So you either take it and put it in the checking, or again, you roll it over to another 5-year term at whatever the new rates are at that time. All right. You don't have to do this alone. Just like the gentleman that didn't understand about doing the Roth conversions, you're going to have some blind spots. We have over 20 years in business here in Austin, helping our clients, and I can help remove those blind spots for you. One of the things that I want to make sure you understand that's available is a written plan. And a written plan these days is obviously online. You have access to it. There's an app. But if we're able to kind of go in and show you, okay, here's a better way of thinking about your retirement, more often than not, we're going to be able to improve your situation. Our proposed plan is going to be better than your current plan for most people. And again, that's because we are able to remove the blind spots when it comes to claiming Social Security, setting up an income plan, doing tax distributions, doing Roth conversions, so on and so forth. So consider taking advantage of this. We're happy to set you up with a written plan. Again, just email me at scott@austinfirstfinancial.com. Our next webinar is going to be next Monday at 4:30. We're going to cover tax loss harvesting, and we're going to talk about, will the recession or depression rob your retirement? We don't know. Is it going to be a recession, or could we be heading to something even more dangerous, which would be a depression? We've got a white paper, 4 things to check immediately, that we're going to have available on that next webinar. Thanks so much for coming. I hope you stay safe. And again, if you have questions, please email me, scott@austinfirstfinancial.com. Everybody take care. Have a good night. Thanks for coming.